So good evening, everybody, and welcome to AXA's 2015 Investor Day. Welcome to those on the phone, welcome to those on the webcast, and of course, welcome to those here in the room. After the presentation, we will have, as per usual, a session of Q&A, and we'll be happy to take questions from those on the webcast or on the phone. Please follow the instructions you've been given, and we will give preference, as per usual, to questions from the room. On the screen, you can see the agenda for this evening. But before we start, I would like to make just one remark. And a number of you have been following the sector and AXA for some time, and you may remember back to the early 2000s. And AXA, at that time, started to build its economic capital model before it was even a well-known concept. It has been a 15-year journey, and our model has evolved quite a lot over that time. What you will see today is the fruit of that work paying off. Denis Duverne, and I remember, I was there at the time, Denis Duverne was the brains and the driving force behind that initiative, and it therefore seems very fitting that he will make the introduction this evening. And without any further ado, I hand over to Denis.
Thanks, Andrew, and good afternoon, ladies and gentlemen. I will do just the introduction and the conclusion of this presentation. Andrew is right. We started our internal modeling at AXA back in 2000. We had organized a competition between consultants at the time, and we eventually selected Tillinghast to support us, and we went for a long-term internal capital model. That was very useful to help us understand the profitability of our long-term business line, like annuities, workers' compensation, the casualty lines. But we realized that we were in a minority, and the majority had gone for a short-term economic capital model over a one-year horizon. We were fortunate when we bought Winterthur in 2006 that they had built their own model over a one-year horizon. And so we adopted the Winterthur capital model, which we further enriched after that. And our modeling team still resides in Winterthur, and they are the ones that have built that model for us. In 2006, 2 years ahead of the financial crisis, we started developing our risk appetite. Unfortunately, we had not fully completed our journey on the risk appetite when the crisis came in 2008, which led to the surprises that you will remember on our US VA portfolio. So we were a bit late on that one. But I believe that when we launched Ambition AXA in 2011, we had fully incorporated in our strategy all the elements of the economic capital and the risk appetite. And that has led us to strengthen our balance sheet, to change our business mix. I will come back to that later. And we have just a few days ago received the approval of our internal model from ACPR. When we say receive the internal model approval from ACPR, it means a lot more than that, because in reality, as you know, we are present in multiple jurisdictions across Europe, and it's not just the approval of the global model, it's also the approval of the local models in each of those geographies, and it's also the input and back and forth, the incorporation of the conditions put by each of those local supervisors on the model, both on the local models and on the global model. So our model is approved. It's approved by ACPR, but it's been approved also by the supervisors in the other jurisdictions, the UK, Belgium, Germany, Italy, just to name a few. Our model is giving us a solvency coverage of 212% at the end of Q3. We had told you that we were confident that we would land within 10 points of our previous model. In fact, we are clearly closer to 1 point of difference between the model that we had published in the last 3-4 years and the model that is now approved. There are lots of pluses and minuses, but we arrive at a number which is very close. The most important thing is that our model is at the heart of our decision-making process and has been I would say, since 2007. This explains why, as part of Ambition AXA, we had put the emphasis on protection and health and unit-linked, which shows in the numbers that we've published in the last 4 years. The unit-linked business has increased in proportion, the protection business has increased in proportion, and the general account savings business, which is the business which is less profitable in the Solvency II environment, has declined substantially to represent, so far this year, only 12% of the new business. Our new business margin has improved substantially, which is a function not just of this changes in business mix, but it's also a function of all the repricing that we've done, because our internal model also drives our pricing decisions, as Alban will explain to you later. It has driven our asset liability management. We've always mentioned our tight duration gap. We have, with our in-force program that we launched 4.5 years ago, reduced crediting rates in a very prudent fashion. We have had a disciplined asset mix, which has allowed us, and these are figures that you will recognize, to have a resilient investment margin between 70 and 80 basis points and towards the higher end of that range. It has also driven our M&A decisions. You will recall that since 2010 we've sold for 9 billion euros of businesses and bought for 5 billion euros of businesses, mostly in P&C and protection and in high growth market. And it has allowed us to have a strong dividend paying capacity with 8 billion euros of dividends paid between 11 and 14, and over 19 billion euros of adjusted earnings. So our capital management is anchored in Solvency II. We have a strong Solvency II ratio at 212%. This is also what drives our decisions in terms of risk appetite. I will not comment all the words that are on this slide, because that would steal the thunder of Alban, our Chief Risk Officer, who is now going to take over before Gérald talks to you about how we expect to manage our capital going forward. Thank you very much.
Thank you, Denis. So, good evening, ladies and gentlemen. I'm happy to be with you tonight, to be able to share our numbers after so many years of hard work. So what I'll do today, I'll take you through some technical details of our model, well, the building blocks of our model. I'll show you some sensitivities of our capital to some shocks and show you how resilient our capital is. And then, as Denis mentioned, a few examples of how our internal model is embedded in our decisions. I think there are two messages today. The first one is that we now have a stable capital framework with Solvency II entering into force in a few months, and our model having been validated by the European supervisors. And we have a resilient capital, as I'll show you in a few slides. So if we start by the number, as Denis mentioned, we stand at the end of Q3 at a very strong 212% ratio. And we have plotted on this slide what would have been our ratio over the last quarters had we used the internal model. And at the top of the slide, what you see is the numbers that were disclosed to you with our economic ratio. And you see, as Denis mentioned, that there is extremely little difference between the two, and sometimes they're even identical. What I want to highlight as well is, you know that we don't adjust for dividend during the year. We do that at Q4. So the dividend is not, dividend to be paid is not taken into account in those numbers. So how do we, there's something missing on the screen. So how do we determine our AFR and our SCR? So we start from our IFRS balance sheet, but we move from that IFRS balance sheet to a Solvency II economic balance sheet. And we determine the market value of our assets, the market value of our liabilities, and the difference between the two is our available financial resources, our available capital under Solvency II. And that stands at 61 billion euros at the end of Q3. Then we determine how much AFR we would lose with a 0.5% probability shock, a so-called 1 in 200 years shock. The amount of AFR that we would lose in such a shock is our solvency capital requirement, and it stands at the end of Q3 at 29 billion. The ratio between the two, AFR to SCR, is our solvency ratio of 212%. Now, moving to some details on how you create a Solvency II or market-consistent economic balance sheet. So you start with the IFRS shareholders' equity, which stands at 71 billion. There are some asset classes for which the unrealized capital gains are not included in the shareholders' equity. That's real estate and loans. And we include those unrealized capital gains in our AFR. You remove all intangibles from the balance sheet, goodwill, DAC, and VBI. And then you move from IFRS reserves to best estimate liabilities. As such, the best estimate liabilities are 24 billion lower than IFRS reserves, and that increases our capital by the same amount. But as there is no market price for insurance liabilities, and there is uncertainty on those liabilities because it's best estimate, we include a risk margin or market value margin. For us, it's the same thing, to recognize that uncertainty. And that's 12 billion. That increases the best estimate reserves and decreases our AFR. And over time, if there is no deviation from the best estimates, that amount should accrue to shareholders. Then you include also in your available financial resources the subordinated debt that is not yet included in your IFRS equity, and that's 7 billion. And overall, that's how you come to the 61 billion AFR that I mentioned in the previous slide. Now, if we move to the SCR, that's the total capital requirement that we have. This describes the model that we have within the group, and the model applies to almost all our insurance entities, excluding the US. It covers 97% of our insurance entities, and the same model, the same different modules of that model apply to all our insurance entities. We have 4 risk modules: underwriting risk, market risk, credit, and operational risk. And we're probably one of the few to have a validated internal model for operational risks. Underwriting risk, it's the insurance risks that we have. Market risk, I think, is rather intuitive, and credit risk is our default risk. You have the numbers for, again, a 1 in 200-year shock for each of those risks. So for instance, 15 billion for underwriting risk. And we gave, in the boxes below, a number of examples of the risks that we model in each category. So for instance, underwriting risk, we would have lapse risk in life and savings, reserve risk, longevity. Market risk, obviously equity, spread, interest rate. On default risk, credit risk, it would be obviously on our portfolio of bonds, but also the reinsurance receivables that we have. And operational risk, it's the risk of fraud, of simply processes that do not work, or fraud. So once you have that, you have for each category the loss of AFR that you would have for a 1 in 200-year event. But as those events do not occur at the same time, obviously you allow for diversification. And diversification between those risks is 11 billion. The next step is the tax adjustment. The SCR is a net of tax amount, and the tax adjustment is 2.5 billion. So that's the total amount of capital required for our insurance operations outside the US. We add to that the capital requirement for banking and asset management operations, 2.5 billion, and just in some countries which are on standard formula. That's a difference with our current Solvency I ratio, where we do not include bank and asset management. Here under Solvency II we do, and that's the 2.5 that you see. And then you add the capital requirements for our US operations, and you know that we use equivalence, and that under equivalence we use 3 times CAL, 300% of CAL, which is not the most aggressive approach in the market. When you've done all that, you come to our solvency capital requirement, which stands at 29 billion. We put together then a couple of slides with some technical details. I don't plan to comment them all now, but I'll be happy to take any questions during the Q&A. Just want to comment 3 of them. On sovereign risk, we do include sovereign risk, both spread risk and default risk in our model, be it for domestic or non-domestic bonds, for OECD or non-OECD bonds. All government bonds are covered. Second item, transitional rules. We don't use any transitional rules, be they for equity or reserves. And third one, it's the UFR, the ultimate forward rate that we use for the discount of our very long-term liabilities. You know that it stands for most countries at 4.2%. If it was to go down by 100 bips, our solvency ratio would go down by 19 points. So on this slide, again, I won't comment any of these, but there are information about market value margin, the volatility adjuster, and taxes. And again, I'll be happy to take questions on that during the Q&A. Now, let's move now to potentially even more interesting part of the presentation, which is the sensitivities of our ratio to a number of shocks. And that will demonstrate how resilient our capital is. So what we put on this slide is the sensitivity of our ratios to financial shocks on corporate bond spreads, on interest rates, and on equities. And you see that for those shocks, even for large ones, our ratio does not move significantly. Now, I will go into the details of that for interest rates and corporate spreads. For interest rates, you may wonder why a shock in interest rates does not affect our ratio. In fact, obviously, it does affect RFI and our SCR. And when you look at an upward shock in interest rates, you see that our available capital goes up by 900 million. And that's clearly what you would expect from an insurance company these days. But the fact is that at the same time, our capital requirements increases by 400 million. And that's between the two, more or less a ratio of 2-to-1, which is also our solvency ratio is 200%. So that's why when they move up, both of them, our ratio overall is not affected. But IFR increases, and so does our SCR. And by the way, it's exactly also what happens with equities, where AFR and SCR increases in a ratio of 2-to-1 when equity markets go up. But you see also on this slide that if interest rates go down, IFR is more significantly affected, and that's because of the convexity that we have in our portfolio due to the guarantees that we have in the options that we have in our products. Moving to corporate spreads, and I know there have been, again, a number of questions on the sensitivity of our ratio to a corporate spread because it's not very sensitive. You will remember that our AFR are the difference between the market value of our assets and the market value of our liabilities. On our asset side, our corporate bond portfolio has a limited duration, a low duration of 4 to 5 years. And that as such means that we are not extremely sensitive to a widening of corporate spreads. If I were to increase the duration of that portfolio by 1 year, that sensitivity would move from -1 to -4. So see that it's not insensitive, but it depends on the duration of my assets. On the liability side, you know that we use the volatility adjuster. The purpose of the volatility adjuster is to recognize that generally we hold our corporate bonds to maturity and therefore will be repaid at par, and therefore our solvency should not be significantly affected by volatility in the corporate spreads. So that's the purpose of the volatility adjuster. The volatility adjuster is not in our hands. It is determined by the EIOPA on the basis of a reference portfolio. And that's what dictates the adjustment to be made on our liabilities. And it so happens that in the reference portfolio, you have more corporate bonds than we do have in our balance sheet. And that also explains why the sensitivity to corporate bond spread widening is mitigated significantly by the volatility adjuster. Conversely, we hold more government bonds than the reference portfolio, and you see that for a shock of 50 bips on sovereign spreads, our sensitivity is a bit more significant because we will lose 9 points of solvency. So this is probably the most interesting slide of my presentation, and if you had one to remember, I would hope that it'd be the one. Because what we've done here is we've used real-life shocks to determine how resilient our solvency would be with those shocks. And you see that clearly it is resilient. So as a reference, we put the 1 in 20 year shock from the model, and that cost us 32 points. 1 in 200 year by construction would cost us 100 points. But then we computed what would be the change in solvency that we would have if we had a number of big crises as we had in the past. So obviously the one that everybody has in mind is the 2008-2009 financial crisis. If such a crisis was to repeat, we would lose 48 points of solvency. Admittedly, this is a significant number, but that's also a very severe crisis. But more importantly, it will leave us at a very strong 164% ratio. But that also tells you how prudently we have calibrated our model, because you see that we would lose 48 points, which is very far from the 100 points that we would lose in a 1 in 200 year event. With the financial crisis of 2011, we would lose 22 points. And then we also went for very specific insurance shocks that we had in the past on the P&C side or on the life side. On the P&C side, we used the two windstorms that we had at the end of '99, Lothar and Martin. If, again, that was to happen again, that would cost us 3 points of solvency. On the life side, we looked for a big pandemic. The largest one that we had in the recent past was the Spanish flu that we had at the end of World War I. That only would be an impact because of mortality losses of 2 points of that solvency. So overall, I think it demonstrates the resilience of our capital. Another way to look at it is to say how much solvency do we create each year and what are the shocks that, so to speak, we can afford in a given year with that amount. The operational capital generation that we have year after year is more or less 20 points of solvency. If you deduct the dividend that we pay, here we put the one that we paid this year on the 2014 earnings, that's 9 points. So you're left with 11 points of net capital generation in a given year. Only with those 11 points can I withstand a shock of minus 60 bps on interest rates or 45% on equity markets, or a combination of 30 bps and 20%. Only with the capital generated in 1 year. Then coming back to what Denis said at the beginning, if our ratio and our solvency are so resilient, it's no miracle, no magic. It's because we have been embedding our internal model in our business decisions for years now. Just want to give 4 examples about this. On products, the example that Denis mentioned was the fact that we moved from capital-heavy products such as general account to capital-light products like unit-linked and protection. But it's also the fact that when we price our products, the amount of capital that we use is the SCR for any given product, and that reflects the risk that we take. And therefore, there is alignment between the risks that we take, the capital that we put at stake, and the earnings that we expect. Full alignment. On investments, we now have, for years, developed a strong and strict budget and monitoring of financial capital requirements. We determine every year the amount of capital we want to dedicate to financial risks, and we follow that on a monthly basis. Still on the asset side, the asset liability management, we've kept now for very large number of years a small duration gap of 1 or close to 1. And finally, the last example I would give is on the insurance side, there is no difference between the internal model that we use for solvency calculation and the model that we use to determine what would be a loss in a significant catastrophic event, and therefore the amount of reinsurance that we need to buy. Again, there's full alignment between the two. And that also explains why our capital is so resilient. That being said, I now hand over to Gérald.
Thank you, Alban. Good evening. So, Alban has presented our internal model, confirming that our Solvency II ratio is strong and resilient. Now, my objective is to present the consequences of Solvency II on our capital framework with a specific focus on these 4 topics. First, the dividend policy. Second, the capital management strategy. Then the capital structure. And next, the cash flow and remittance ratio. So let's start first with the dividend policy. So I'm proud to announce that we are setting our payout ratio, our payout range at a higher level. Up to now, our dividend payout ratio was between 40 and 50% of adjusted earnings. As you can see here, we have been using the full range of our payout ratio. And from now on, we are increasing our payout ratio from 40 to 50% of adjusted earnings to 45 to 55% of adjusted earnings, which is great news for our shareholders. So let's have a look at our capital management policy. Here, we are presenting 4 different scenarios. A first one, which is, I could say, a central case scenario, from 170% to 230% of solvency. Next, an upside scenario above 230%, where we could even do more. And a downside scenario between 170 and 140%, where we would protect our shareholders. And then an extreme down scenario below 140%. Let's start first with our central scenario, i.e. between 170 and 230%. So our dividend policy will be based on 45 to 55% payout ratio, as I explained before. Then we will neutralize dilution of employee shares and stock option offering. We will invest in business growth. We will maintain current investment risk appetite. Above 230%, and as solvency increases, we'll add flexibility on the payout ratio. We will add some room to invest. We will have additional room to invest in business growth. We will increase our appetite for investment risk, and we could be in a situation to return excess capital to shareholders. Below 170%, and we will gradually, I would say, be more conservative. First, with selective de-risking of investment, increase selectivity in growth initiatives. We would allow for dilution of employee shares and stock option offering. Then we would have additional flexibility on the payout ratio. And in the extreme event where we would be below 140%, then we would restrict our growth initiatives, we'll further de-risk of investments and reduce dividend payout ratio below the range. Have a look now at the capital structure. So our Tier 1, as you can see here, our Tier 1 is very comfortable and represents 84% of AFR. As you know, hybrid Tier 1 is limited to 20% of total Tier 1, meaning that under stress scenarios, our Tier 1 would be limited. That means that if Tier 1 would drop, then by definition, our Tier 1 debt would be haircut and considered as Tier 2 and declassified in Tier 2. This, combined with our strong solvency generation of plus 11 points as presented by Alban a few minutes ago, means that as a consequence, and given our strong financial structure, we believe that we have flexibility to renew part of our Tier 1 debt by Tier 2 or senior debt. Let's have a look now at the cash flow management. So before going into more detail on the cash flow generation and cash flow generation of new business, I would like to remind you that we are going to maximize cash upstream to the group. That means that concretely we will maintain limited volatility buffer above the 100% Solvency II level, and meaning that as a consequence we will have some local excess capital in some countries, and you have examples here like France, Life and Savings, like Germany P&C, like the US. So that means that on the next years we will strive to maximize upstream to the group. How could we do it? And you have it's mentioned here. First, we will reduce local excess capital. We will maximize ordinary dividends. We will simplify our legal structures, and we could do some risk pooling as well. So, as a summary, we have excess capital in some entities. So let's analyze now how the free cash flow generation of new business works under Solvency II. So here we are dealing with the cash consumption from life and savings new business. So I'm dealing here with the 2014 figures. Under both frameworks, on the left-hand side you have Solvency I, on the right-hand side you have Solvency II. So as you know, the new business cash consumptions has two different components. The first one, which is the new business strain, and you can see here under the two frameworks, it's exactly the same. It was 1.2 billion, that's the cash corresponding to the strain, 1.2 billion in 2014. Whereas for the new business required capital, it's not the same under Solvency I and under Solvency II. It's the same for non-European countries, it's 0.2 billion, but for the European countries, these capital needs, these capital requirements can be covered with a new business future profit, which means that as a whole, the consumption, the cash consumptions from life and savings new business, which was at 1.9 billion, taking the example of 2014, which was at 1.9 billion under Solvency I, will move to 1.4 billion, i.e. an improvement of 0.5 billion. You can see here, and it's mentioned, that as a consequence, the new business internal rate of return is improved as well. And taking the example as well of 2014, we would, where it was our internal rate of return was 14% last year under Solvency I, it would be 17% under Solvency II. As far as P&C and life in force free cash flow, roughly speaking, it would be broadly the same, which means as a whole that we have an annual uplift of free cash flows of 0.5 billion, and that means that our free cash flow concretely will be higher. And now I propose you to move to the remittance ratio to see how much real cash will be upstreamed to the holding company. So our remittance ratio will be maintained between 75 and 85%, which means that taking the example of 2014 on the right-hand side, that means that where under Solvency I we had a free cash flow, we posted last year a free cash flow of 5.5, and we had a remittance ratio of 86%, which was at the slightly above the 75 to 85% range, which meant that we had 4.7 billion of cash that was upstreamed to the holding company. Under Solvency II, as I explained before, we can expect to have 0.5 billion more free cash flow, and assuming that we would have an 80% remittance ratio on average, that means that we would have an additional 0.4 billion of cash that would be upstream to the company. Instead of 4.7, we would be at 5.1 billion. As a conclusion, I could say that we can expect to have much more cash upstream to the holding company, and this is why we are confident in our ability to increase our payout ratio from 40 to 50 to 45 to 55%. And now I hand over to Denis.
Thank you, Gérald. I would like now to wrap up and summarize the key messages of this presentation. Strong Solvency II ratio at 212% at the end of Q3 under our approved internal model. This is no surprise because this framework has driven our strategic and operational choices in the last several years: product mix, investment mix, risk mitigation, and portfolio diversification. Our Solvency II ratio is very resilient to a variety of financial and non-financial shocks. We have now a very clearly defined capital management framework with a range of 170 to 230%, within which you shouldn't worry about the volatility of the ratio. We are able to increase our dividend payout ratio range to 45 to 55%. We'll have a higher free cash flow on the life side by roughly €500 million annually. And in spite of that, we can maintain our remittance ratio between 75 and 85%. I will add one point, which is that we will, within our capital, continue to increase the quality of our Tier 1 by increasing the core Tier 1 part and slightly reducing the Tier 1 the Tier 1 debt part. With that, I'd like to thank you very much for your attention, and now hand over the floor back to you for questions and answers. First one in the back.
Thank you very much. Thank you very much. It's Andy from Macquarie. Just looking at slide number 19 in your pack, and which I thought was a typo in your pack, but you didn't mention it as well. The 1 in 20 years shock is 32% from the ratio. Consumes 32% from the ratio. But normally when I think of 1 in 200, it's normally 10 times worse than a 1 in 20. So it's obviously not in your case, in your model. So somehow, I guess, as you go from 1 in 20 to 1 in 200, AXA becomes more resilient effectively, either through hedging or management action. So I guess, what am I looking at in this 1 in 20 shock? And what, obviously, if the hedging kicks in at 1 in 200, is there a worse point between 1 in 20 and 1 in 200 that I should be thinking about in terms of pressure? Thank you.
No, there is no linearity in the shocks between 1 in 20 and 1 in 200. You can't say that 1 in 20, 1 in 200 would cost 10 times more, and that's true for us, that's true for all our competitors. There is a distribution of losses. We look at 0.5% probability or 5% probability. And you see that 0.5% probability would cost us 100 points, and 5% would cost us 32 points. But you cannot infer from the probability that the shock would be proportional.
Hi there, thank you. Fruit from Citigroup. I don't understand your cash flow because we're getting mixed signals from other companies. So surely when you write new business, market consistently, if you're pricing that way, you should be creating value. So why is there a new business strain? And then also, on your back book, you should be releasing risk margin. It must be it's obviously a very big number. It's 12 billion added to your liabilities. So just wanted to understand, are we just thinking about this incorrectly? Because I think there's an inconsistency opening up between the way the different companies are reporting cash under Solvency II. It may be that you have to take me offline to answer that. Second thing is, why 75 to 85% remittance? So if you're saying you keep a slight buffer locally, there will come a point at which you can remit all of your cash. So what is still the constraint in your business? Is it the US? Last point is, why have you moved to 300% CAL? I mean, is that equivalent to what you would say is an economic capital equivalent sort of level, or is it as a regulator told you to move to 300%? Thank you.
Gérald, do you want to take the question?
I'll start with your question about the 75 to 85% remittance ratio. Keep in mind that what you say would be absolutely true if you would have only European companies. But it's not the case. You mentioned the US, and as you know, for the time being, the US, as we said in the past, have the capacity to upstream quite significant amount of cash. Remember that in the previous meeting we said that we could expect between 600 and 1 billion, so it's still true. But look at Japan, look at Switzerland. That means that these countries have tougher regulatory constraints and framework, which means that in the end, on average, we are quite comfortable saying that it will be 75 to 80%, 85%. That's the main reason.
Do you want to take the question on the new business strain and the life business?
So your question, I'm not so sure that I understood your question about the new business strain. That means that the new business strain is anyway something which is statutory. So that means that it won't change. So that means that what does it correspond to? It's purely cash. So that means that you have to pay your commissions, and the fact that you have to pay your commissions makes that you have a cash drain.
Plus internal acquisition expenses.
Plus internal acquisition expenses, agreed, which means that you have a cash drain, which is, I would say, the same whatever the framework. So it's purely cash. It's in and out.
So the local gap is not changing?
No.
It has nothing to do with local
It
gap.
has nothing to do with local gap. It's a local. It's a local cash needs. So it's what we call the strain. It's exactly the same. Just have a look at our EEV framework. It's exactly the same. That's what we call generally the strain. So that's why it's. I hope I answer your question, but it's really something which is quite the same, taking the different countries.
I would add one point, which is that on the new business required capital, it's really a function of your mix of business. So if your mix of business is quite profitable, which is our case, then you don't have any additional new business needs in addition to what VIF you create. If you have a different mix of business which has a lot of guaranteed general account business, then you could still have a new business required capital on top of the VIF. Is that clear?
Yeah.
The 300%.
Yes, but, so the 300%. Yes, we have heard different figures coming from different competitors. But what you don't know and what we don't know is what has been required by the respective supervisors in terms of add-ons. So we can tell you that 300% for us is what we believe is required by the local regulator, and that's why we put the 300% as the equivalent of 100% in Solvency II. For the companies that have taken a lower figure, it may mean that they've had a capital add-on separately, and so I'm sure that there is fairness across geographies because the same supervisors are supervised in different groups, but that may be handled in a different way. Nick in the second row. Microphone. Oh, sorry. No, I didn't see.
Hi, it's Nick Holmes at SocGen. Sorry, apologies for my croaky voice. First, two questions. First is on the dividend, the new payout ratio, 45 to 55. Previously, with 40 to 50, you started at the bottom and have worked your way up. And the question is, can we expect a similar sort of progression? I mean, for the dividend this year, presumably, well, I mean, can you give us guidance? Are you expecting it to be 45, basically, for this year? That's the first question. Do you want me to give the second question, or do you want to... Second question is looking more optimistically at the progression of the dividend. And I wanted to ask, you've always been a leader in prioritizing unit-linked and being capital efficient. We can see the benefits coming through. But because you've always been a leader, how much more scope do you think there is? And I'm thinking in the context of Solvency II, which is a regulatory framework that favours the strategy you've had for a long time. One would imagine that there could be quite a lot more scope to improve your capital efficiency and to sell a lot more unit-linked. And I wondered if you could possibly share your thoughts with us on that. Thank you.
Okay, thanks, Nick. On the first question, I'm afraid I will not give you more guidance. If we define a range of 45 to 55, that this is to leave us the flexibility to be any place between 45 and 55, and I will not give you more guidance, and you would be surprised if I were to. On the second topic of unit-linked, I believe it's a very important topic for the whole industry, especially in the context of low interest rates. And I think it has more to do, our ability to go beyond the proportion of unit-linked that we currently have, has a lot more to do with how financial markets evolve. In other words, we have had quite favorable markets, equity markets in the recent years, and that has helped us improve the proportion of unit-linked. But it also has a lot to do with the product design and the sales tools and training that we give to our sales force. Because I believe that our customers still want some guarantees, and we need to do a better job of guiding them through the asset allocation that will make them have enough money for their retirement. And so it's a long process. It's a process where all the industry has a challenge. If we want to develop unit-linked, we have to make sure that we sell products with the appropriate asset allocation, and convince our customers that even if they are 50 years old, they would still normally need to have 50% of equities, which and sometimes the regulation goes against that. So this is a big topic for the European industry, with rates at zero. And you heard today that QE would continue until at least March 2017. Clearly, the savers would need to invest more in equities, and it's not obvious with the mindset that most people have in continental Europe. But it's definitely a challenge for the industry.
Just may I just a very, very quick follow-up on the subject of unit-linked. In France, if you look back far enough to the early 2000s, I think it was as much, unit-linked was as much as 40% of new business. Do you think Solvency II could drive a return to that?
You were talking about the industry figure
I'm talking about industry, yes, not your own.
So this would allow me to make a comment on the Danish Compromise. You know that the Danish Compromise allows the banks to double count their insurance capital, and it is clear that this means that there was less concern on the banks in terms of their capital consumption. And if the Danish Compromise is prolonged, this trend will continue. So there is clearly a situation where pure insurers are at a disadvantage against the bank insurers, who are less worried about the way their insurance capital is consumed. But having said that, I believe that there is now a bigger awareness that this is not going to last forever, and we see also the banks driving more unit-linked.
Thank you.
Going back.
Thanks. It's James Shark from UBS. I had three questions, please. The first one is on the corporate credit spread sensitivity. On slide 15, you show that with stable volatility adjuster, there's a 13-point impact on the Solvency II ratio, whereas over the page, it's only 1 point. So am I correct in assuming then you're assuming a dynamic volatility adjuster? And then kind of connected to that, I'm interested in, obviously, the economics are such that you clearly are exposed to credit spreads. So as long as the credit spreads blowout is driven by illiquidity, then the volatility adjuster is fully justified. So I'm kind of keen to understand what your default assumption is within the corporate credit spreads, and actually what happens if you double the corporate credit default assumption within that, so I can get a feel for what the true economic sensitivity is to corporate credit. So that's my first question, please. Secondly, the range of 170 to 230, that's a 60-point range. You make a big point about you've got low level of volatility. So why do you need such a big range? At what stage can you see yourselves narrowing that range? That's my second question. And third question is just quite a simple one, really. Could you give me a reconciliation between the basic own funds and the eligible own funds, please?
Alban, do you want to start with the first question?
Yes, so on credit spreads, you are right in assuming that we use the dynamic volatility adjuster, but that's an SCR issue, not an AFR issue. The dynamic volatility adjuster is used in the SCR. And you will have seen in the slide that what really matters in the corporate spread sensitivity is the AFR. So what we have shown on the slide that you refer to is if in RFI, in the liabilities, the volatility adjuster were not to move at all, then the sensitivity on the asset side would give the number that you have on that additional slide. But it's irrespective of what happens to the SCR with the dynamic VA. But you're right in saying that we use the dynamic VA. On your other question, which is the default assumption, so that you're speaking of corporate default, right? That's not in the market risk, that's in our default risk. And the number that we show on slide 13, the 4 billion, mainly relates to corporate default, much more than to receivables and so on. So that's the amount that we would have.
And you had the third question?
Well, the second question of the first part, the second part was the range.
Oh, sorry. Yeah, on the range. Look, we have a ratio which, as we say, is very resilient. But we remember the situation at the end of Q1. You see that the ratio dropped by 10 points. And it was, it was a big issue for the analyst, and we want to tell you that we are not worried by movements of 10 or 20 points, and because markets will move, our ratio will move, and we are running a very long-term business, and we are not going to take short-term decisions on the basis of those short-term movements. So we tell you we feel very comfortable within that range, and you shouldn't worry about it. Yes, arguably it's a big range, but we are comfortable within that range, and we don't see the benefit of moving to a narrower range, which would lead to major strategic decisions. We don't believe it's the right thing. So the reason why we've put a large range is because we want to manage the business on a long-term basis, because this is a long-term business, and not on short-term fluctuations.
And then just on the basic own funds and the eligible own funds.
I think you're referring to the difference between, the difference is the operational risk generally on this, but that's for the standard formula. Or am I mistaken with something? I'm not sure to understand your question.
No, because... you have, to the extent that the AFR is just the difference between the market value of the assets and the market value of the liabilities. You have you would have the basic own funds, and then there's restrictions over the amount of the basic own funds to get you to your actual eligible own funds under the Solvency II framework. Perhaps we can follow up later.
Yeah, because I'm not sure I get your point.
Okay, no problem. Thank you.
Since I've got a mic.
Okay, sorry.
We'll come over here. It's Oliver Steele at Deutsche Bank. Two questions. You talked about increasing your equity tier one, at least I think that was the understanding, relative to the debt in that tier one. Do you want to just give us some sort of guidance as to over what period and how far you want to move those ratios by, just so that we have a sort of sense of how you might use free capital generation going forwards. And then secondly, Alban talked about the regime being stable from here. Is that right? Or what changes could you expect from here on?
Gerald, do you want to take the first one?
Oliver, About your first question, going back to the cash generation. So Alban mentions that we can expect to have an 11 points cash generation year after year. As you know, this is after dividend, but taking, we are used to many times we mentioned that we would have external growth and let's say 1 billion of M&A. What does represent 1 billion of M&A? It would represent, assuming that the goodwill would be 1/3, it would be -3%. Assuming that it would be 2/3 of the value, i.e. 600 million roughly, it would represent -6%. So you can, I believe that this gives you a good approximation of the fact that we can expect on a net basis, on average, to have an operational cash generation, let's say, between 4% and 6%, roughly speaking, and that gives you. So, and again, what I said is that Tier 1 under stress scenario is not so resilient, so that I believe that it gives you an idea of the speed and the pace at which we could recover. Just and presently we have, as mentioned in the appendix, we have 9 billion of Tier 1.
And you want me to take the second question?
Yes.
So I think there's been a number of back and forth in the construction of the Solvency II framework. So everybody now wants to use it. And when I say everybody, it's both the insurance industry and the supervisors before potential changes are implemented. Obviously, what you may have in mind is the discussion on the UFR. There won't be any change on this, at least until the end of 2016. The UFR then, during 2016, will launch a consultation on what should be the level of the UFR. What the industry is saying, the CFO Forum, CEO Forum, Insurance Europe, and so on, is that we need stability. And so for the next 3 to 5 years, we are asking the supervisors, the regulators, not to change the UFR because we need stability in Solvency II. That's, for me, the one thing that could change. And I will not mention the ICS and insurance capital standards that might come in so many years.
Yeah, the other topic that could change is the sovereign risk charge in the standard model, but as you have seen, we are already taking it into account in the internal model.
Yeah. Sorry. There you go.
Thank you very much. And I didn't quite understand, and I'm on slide 27, you talked about the local excess capital, and I just wondered if you could just say again what you meant. I didn't understand if it's already excess, or it's going to be excess, or it's going to be released, these France and Germany and US. And then on slide 24 and 25, so slide 24, what strikes me is the dividend never goes down, and slide 25, you use slightly different words for the different scenarios according to dividend flexibility or outside range. And I just wondered whether underlying this, you've got a kind of commitment to a ratchet dividend. In other words, the payout 45 to 55, but not cutting it. That seems to be coming through, but maybe I'm wrong here. And then you mentioned the balance of deals in the past, so that was positive. You released more capital than you reinvested. Is that right? Now we should expect 1 billion roughly to be reinvested net every year. Thank you.
I start with the excess capital. It's on page 27. Let's put it this way. As you know, in a Solvency I world, we were quite highly reliant. We relied on the unrealized capital gains, and you know that the unrealized on bonds, and the unrealized capital gains, by definition, were extremely volatile. Here, I would say that it's completely different, and obviously, today, yes, we have some capital excess, mostly in the countries that are mentioned here, but it's quite volatile. And tomorrow it will be different. That means that it will be less volatile. What do I mean by a buffer? let's say that a buffer, it could be between 130 and 150, but what is above these levels can be distributed, not in one day, but progressively, and that's what we meant. Which means that we are quite comfortable to say that over time, it will be possible to distribute more, and that's why we have we confirmed that the 0.5, the example of 0.5 billion could be distributed because we will have this capacity to upstream cash through the return earnings locally in the different entities. And it's mostly the case for European entities, of course, because it will be, it's much more complicated, again, relative to countries like Japan or to countries like Switzerland, because the framework is different. But it doesn't mean that we won't do efforts in order to reduce and to optimize capital in these countries.
On the dividend payout range, I mean, I don't think I can tell you more than what is on slide 25. Basically, we say that between 170 and 230, we are confident that we can pay a dividend between 45 and 55% of adjusted earnings. It means that outside this range, we might have to change the payout ratio, either upwards or downwards.
And within the 170 to 130, given the history of maintaining at least the same dividend, is there a kind of implicit commitment to maintaining the dividend, or is that completely flexible depending on the earnings?
I mean, obviously, all companies tend to have a policy where you try to smooth the pace of growth of the dividend. I will not tell you anything more. That's a rational thing to do, and that's what all boards will eventually propose to their shareholders.
And on deals?
On deals, yes, we have already indicated in our previous calls or investor meetings that we would expect that the balance between acquisitions and disposals might be different in the future, that we would have probably slightly more acquisitions than we would have disposals. That doesn't mean that we say that we won't continue to make disposals, but on balance, we would expect the balance to be slightly positive instead of having been negative or having more acquisitions than disposals going forward.
Thank you. Hi, it's Ralph Hipken from KBW. Just two things. One, going back to slide 28. I'm not entirely sure I understand why under the Solvency II framework the new business required capital goes down. So would value perhaps some comments on the dynamics there. And second, going forward, let's start with the past. I mean, in the past we had now a very stable framework of reporting cash within the MCV framework. Could you give us some comments how you plan to perhaps report on cash in the future under the Solvency II framework? Thank you.
I want to take the two questions.
Yes. Starting first with Ralph, your first question about the page 28. So, as you know, the biggest difference between Solvency I and Solvency II is that you can benefit from the future profit. Let's call it the value of in-force business, the VIF. So what does it mean? That means that up to now, where you had to post capital, let's say 4%, 1%, etc., you had to post capital, which was hard capital in front of, in order to do new business. In the future, depending on the type of business that you will write, you will have less capital requirement, hard capital requirement. In other words, and that's our case, the fact that we are doing, as mentioned before, more unit-linked and more protection means that we have future profit, and we are benefiting from this situation. So that's exactly what we want. That I wanted to mention here and to present here. Your second question was about cash.
Yes, cash in the how we will report cash flows in the future?
Yeah, we will report, so that means that most probably we will report on a format which will be fundamentally different from the one of EEV, clearly highlighting the cash flows. That means that our format, which was based on free cash flows, remittance ratio, how much cash, will be the same, except that on the capital requirement, we will adjust it. But you will have a strong, we will keep a strong cash flow reference.
Sorry, there was a question here. Thanks.
Blair?
Yeah, thank you. It's Blair Stewart here from Merrill's. Just following up on the cash generation, you talked about the reduction in your cash consumption, and the implication obviously is that your cash generation is the same as it was under previous disclosures. Is that right? Firstly, and following on from that, will you give clearly the unwind of the discount rate in Solvency II is a low unwind, and then you have a real world investment return on top of that. Is coming back to the point about presentation of your cash generation, presumably you will present it on a real world investment return perspective rather than just simply the unwind of the Solvency II discount rate curve.
Anyway, what I can say about your last question, Blair, we will go on for the sake of calculation of the IRR, for example. You will need to have the risk-free rate plus the additional plus the risk margin plus the spread. So that means that we will do it also in a real world. So that means that it won't be very different. That means that you will have the cash flows and the cash flows under the management case that will give you the capacity to calculate, as we do today, IRR. So that's, honestly, I don't believe that it will be, that's why I said it will be very close from the present framework, except that there will be some small modification and we will have opportunity to discuss it on the right time.
Yeah, no, I think that's clear. Just two very quick follow-ups and very quick additional questions. You've given some indication in the past of the impact of using US equivalents in solvency points terms. Is that something that you're prepared to share now, or is that something that's in the past? And secondly, there's a bit confusion on this with different companies you speak to, but will you publish, or will you be required to publish your solvency ratios without or excluding the impact of the volatility adjuster?
About US equivalence, we said that in the past that it would be between 30 and 40 points, so it's still the case. About the volatility adjuster, the answer is no. That means that it will be required within roughly, if I'm right, it should be in mid-2017. Yes. Before, the answer is not.
There was a question in the first row here.
Good evening, it's Andrew Crean at Autonomous. Could you, there's three things. Firstly, what is the benefit of the internal model relative to the standard formula in terms of your coverage ratio? Secondly, when I'm thinking about your remittances, you're basically indicating you're going to cram down on the local regulators and try and push as much cash up to group as you can. Does that mean that the 75 to 85% has some element of sort of latent capital being pushed up, or is that the sort of ongoing rate? And as regulators will settle down under Solvency II and begin to understand it themselves, do you think that they could be open their shoulders a bit more and allow money to come up? And then thirdly, on slide 13, where you've given the underwriting risk, market risk, credit risk, probably not now, but would you give us a bit more understanding of the different elements within the market risk and the underwriting risk? The 15 billion a hit, it might be quite useful to understand how much of that is equity risk and all the other components.
As far as your first question, that means that as far as the internal model is concerned, we don't we benefit from this internal model, so we don't give the advantage of the internal model relative to the standard formula. It's not something which is required at all in a Solvency II framework, and at no time it will be asked for. About your question relative to the remittance, I would say that so long as you will use new business future profit, if we want to take all benefit of this new business profit, for sure you will use some retained earnings, local capacities that you would have in the local entity, and that's what we will do. So that means that we will, as much as so long as we have significant excess capacities that over time could be upstreamed, then that's why the 75 to 85% is something that we can confirm, and where we switch, we are quite comfortable.
And this is so you should interpret that as meaning on an ongoing basis, and not as something that will result from, as you say, pushing a lot of money upfront in year 1 and 2, and then not having the ability to push as much in the later years.
But that suggests you could, in the first few years, actually push up more than 85%, as some of these one-off excess capital get moved up.
Maybe, but on the other hand, we have some internal debt that we would unwind.
But nevertheless, as I said, what is important to keep in mind is that even net of this internal debt that would be unwound, there is capacity.
And on your last question, what I can tell you is on page 13, the examples that we gave in the boxes are in decreasing order of importance. So in our market risk, equity risk is more than spread risk, which is more than interest rate risk. And for those who might wonder why equity risk comes first, though we have a limited exposure on our balance sheet, you should remember that our unit-linked business has some equity exposure, and we might lose future profits from our unit-linked business if equities decrease.
Thanks. This is William Alderkin from Goldman. 2 questions. First of all, the guidance you've given in terms of the Solvency II capital structure on slide 26, does that supersede, or how should we think about that in the context of the IFRS balance sheet target leverage range of 23 to 25%? And then secondly, going back to I think you make a statement on slide 11 that you expected the capital generation from the in-force on the life business to be roughly stable, Solvency I compared to Solvency II. I just wondering, is there a sort of simple explanation of why that's the case, given there seems to be so many moving parts that change moving to a full market value balance sheet, and hence why net there isn't a sort of any material change?
On your first question relative to our tier one debt, I would say that this doesn't change. Look at what I said. I mentioned that we still have a 23 to 25% target. We will keep it. It's our interest. And we always said that below it would be considered as not in the interest of the shareholders. Nevertheless, you can imagine that over time we could have some part of the tier 1 debt that could be replaced by other categories, and that's mostly it. No need to pay for a spread, which is quite important. We will keep the present range in terms of debt while reinforcing our capital structure.
The other question. question on the cash flows from Solvency I to Solvency II as well.
The cash flows from the in-force.
Yes, the cash flow on the in-force, it's quite, it's not something which is so easy, as you can imagine, and you mentioned it. Thank you. But anyway, you can, we looked at it, and I said it's broadly the same. So we cannot accept to have big differences. What I could say, and that what I didn't mention, and it goes back to the previous question, is that so long as for the in-force as well, you will benefit from the VIF, makes that if you have some capital available, then you could benefit from this. But I didn't take into consideration, and that's why in the presentation I focused only on the new business. But it's also something which is possible, but it goes back to the capacity to decapitalize the company and to make the VIF to monetize the VIF. That's another way that I could explain it. But broadly speaking, everything equal should be more or less the same.
Hi there, Farouk Ali from Citi again. So it seems to me from what you're saying that it's more attractive to buy stuff in Europe because you've got a market value frame which is looking similar to what you had before. You know, you have a big diversification benefit. I'm just wondering whether this is informing your M&A. And secondly, is there any convexity in your 75 BIP corporate bond spread sensitivity? Because I know you've got credit derivatives on the balance sheet. I know that they're not necessarily there to hedge, but can you talk about any convexity that gets more negative beyond 75 bips if we get a really big shock? Thank you.
So on the M&A strategy, we are not going to change our M&A strategy in any significant way. We will continue with the strategy that we have had in the last 4.5 years. Focus on P&C and protection, focus on high growth markets, and you should see a continuation of the previous trends there. On the convexity, do you want to take that, Laurent?
No. Go there. No, apparently, you know, there is. I don't see any convexity. That means that there is convexity when there is a kind of option. So that's the case for interest rates, but not for spreads. So that's
If anything, we do have some protections on corporate spreads widening, so that would protect us against, well, slightly, but against a significant shock. So I don't think there is convexity in that.
Question in the back.
Thank you. It's Andy from Macquarie again. A couple of questions. The first one is on slide 12. I couldn't find any adjustment for fungibility that you talked about. Is it right to assume there isn't really any deduction for fungibility, or there's no fungibility problems assumed in the Solvency II framework? And the second one is, I'd just like to kind of touch a bit more on the volatility adjuster and the comment you made that because you own lots of government bonds, it's actually quite positive when the volatility adjuster increases. So the kind of regulator's happy with you assuming the credit from the volatility adjuster, even though you own a portfolio of mainly government bonds. Thank you.
So on fungibility, there is a haircut of 500 million, and that haircut is the recognition that the minority shareholders' funds cannot cover other entities' losses, and that mainly comes from our AXA MPS minority shareholders, and that's all. There's no other haircut in terms of fungibility. On the VA, the reference portfolio has a certain percentage of government bonds and corporate bonds, and all the industry has to use the VA that comes from that reference portfolio, whatever they have on the asset side. And given that we have a different mix than which is more conservative, as I explained during the presentation, the corporate bond spread widening is more mitigated than the government bond spread widening, and that's why you have that 9 points sensitivity for 50 bips, whereas it's closer to 0 for the corporate bond spreads. Does that answer your question?
But you're okay to assume that, though. There's no question about everyone's happy with you assuming using that in your SCR. How big is the benefit out of interest?
Okay, so the on the AFR, we use it like the rest of the industry. On the SCR, that was part of the model that was approved by the supervisors. So everybody, if you refer to the supervisors that looked at our model, everybody's happy with that, yes.
Thank you.
Question in the front.
Yes.
Thanks. It's James Shark from UBS again. Just a couple of quick follow-ups, please. You mentioned the government bonds are risk charged. Could you just outline what your approach is there? Are you just treating them like normal corporate bonds based on the credit rating, or in particular with Italy and Spain, I suppose? And then secondly, just returning to the cash generation, you can see that the strain in year one is positive on capital generation. Obviously, you mentioned that it's on a Solvency I basis, moving to a Solvency II, but I'm thinking about the capital generation from the back book. So, at the moment when we look at your MCEV disclosure, we can see how the required capital, runs off as we move through 1 year. So my question is really what happens to that level of required capital release in the near term as you transition to a Solvency II environment?
So on the first one, which is the government bond risk charge, so like for all the other risks, we look at past volatility. But here we look at past volatility country by country. So we would effectively have different capital charge for a Spanish government bond or Belgian one or French one, but based on the volatility that you've seen over the past years, and notably in 2011, 2012.
Yes, the euro financial crisis has had a significant influence on the capital charge for sovereigns.
Yeah.
Second question, Gerald.
About your second question, that's not very far from the previous question. And what I said is that the way we'll release capital on the Solvency II world will not be exactly the same, but more or less it will be in line. So that means that we cannot expect to have very big differences. And keep in mind as well that before in the Solvency II world, we were using 150% of Solvency I, so which means that we had already a certain amount of cushions that was used in our EV reports. But again, wait for we will present it with the 2015 accounts, and we will present a new format, and we will have the opportunity to rediscuss at the time, but don't expect big differences on that side.
Just to follow up very quickly on that. So for Italy, for example, what can you actually tell me what your capital charges are for Italian sovereigns?
I don't think we want to go into the details of our various capital charges for various risks.
Question in the first row.
It's Andrew Green again. Well, the one thing I don't understand is that the most important slide, according to you, is this one about resilience. And the least resilient situation was the 2008-2009 financial crisis, which hit you by 48 points. Now, that essentially was a credit crisis. Given the fact that you're saying that you're very resilient under a credit situation, how come that is minus 48 points?
So it was not only a credit crisis, because at the same time you had equities going down, you had interest rates going down, you had credit spreads widening.
And volatility.
And volatility significantly increasing. So you had all those asset classes going the wrong way. And obviously when I showed you the shocks, the individual ones, but naturally when they are severe and they are combined, the total combination of those shocks is more than a simple sum.
Perhaps it might be interesting afterwards to have a feel for what was going on there within the 48 points.
Michael in the second row. If you can you pass it?
Thank you very much. Again, a stupid question, because I don't understand what the tier one discussion, and I'm a bit lost. You say you want to reduce it or improve the quality, but not change the debt ratios. Can you just give an example of what you intend to do, just so I understand? That's all. Thank you.
Okay. Let's say that you could you could imagine that we will have within the next years some Tier 1 debt that will mature. And we could decide that part of this maturing debt, instead of being renewed as Tier 1 debt, will be replaced by senior or Tier 2, which will be cheaper. At the same time, the fact, and it goes back to Oliver's question about what do you expect, that means that the fact that we have capital generation of 11 points minus eventual M&A makes that you have an accretion of your solvency, and I believe that you have the answer to your question. I'm clear? Or not?
Not the last point.
No, yes. The last point is but the last point is the fact
retained
that
earnings. You have
okay. You have imagine that you have replaced a Tier 1 debt with a senior. So immediately the effect would be to decrease your solvency ratio. Okay. But progressively, the fact that you are accretive and that you have, let's say, a few points that increase your solvency ratio makes, while over time, while keeping the same solvency ratio, you end up with a structure which is stronger and cheaper.
Any further questions? Yes.
Just how have you treated your own pension funds within the pension fund within the solvency? On what basis? Is it the accounting IAS basis or the funded basis or what? And the second question I was just going to ask, well, just for numbers purposes, can you provide the breakdown of the 2.5 billion between asset management, banking, and the others?
So on the first one, we use for own staff pension funds on the AFR, which we have on our IFRS balance sheet. There's no difference. But in terms of capital required for our pension funds, we use the same model as for the rest of our activities. So there is a capital requirements for our pension funds, which is built the same way.
It's in excess of the amount under the IAS basis.
No, for the AFR, what Almo just explained, we take the IFRS basis. Yeah. It's deducted. I mean, we don't change the existing deduction, but for the SCR, we include a charge which is based on the structure of the liabilities.
Are all companies doing that? Do you know if everyone's doing that same basis?
No, I'm not sure I know, but it was something shared, obviously, by our College of Supervisors, where almost all European supervisors are represented. So I would think that our competitors should do the same, but I can't assure you of that.
Your second question, Rob, was
the breakdown of the capital requirements for. Yes. So I might have to come back to you on that one.
Okay. Blair.
Just coming back on the Tier 1 debt instruments that you have at the moment, my recollection is, firstly, they're very long dated, and secondly, they're very cheap. Certainly cheaper than equity. Why would you want to replace those with equity, or am I missing something?
No. The point is that it's very long, yes, but there are calls, as you know. Second, about the cost roughly is 4.6%. Okay, and that's it. And second, we could say that this debt is, as I said, under stress scenarios, it wouldn't be extremely resistant. So that's all these reasons combined makes that we decide to do this. Look, today, under today's condition, replacing, let's say, Tier 2 debt or senior debt is much cheaper.
Any further question? Michael again?
Sorry, can you pass that?
So the
the very slight puzzle, but so you distinguish between the Solvency I strain of new business and the Solvency II, this 0.5 billion benefit, which is lovely. But you've been running your company on this for a while, so presumably what you're telling us today you've been actually doing before, or I don't quite understand. So if you've been using this framework until now, this change from Solvency I to Solvency II and the cash upstreaming, is that a real change, or is that just a kind of information change for our benefit?
No, it's a real change. That means that we were not ruled before by Solvency II. We could not use the future profit of our in-force business just in order to match our capital requirements. No, it's real.
It's real. So you're going to pay us pay us. I don't own any shares in AXA. You're going to pay the lucky shareholders here an extra 500 million for 15. Is that right? Or is it 16 that it comes into force?
Comes into force in 16.
Comes into force in 16. Sorry, beg your pardon. Thank you.
Okay.
Yeah, Rutger Franz, Societe Generale Credit Research. Sorry, one more question about your capital structure. You were talking about replacing Tier 1 hybrid with Tier 2. But do I understand you correctly that you leave the door open to replace some of your outstanding Tier 1 hybrid with new Solvency II compliant Tier 1? And would you consider being the first issuer issuing Solvency II compliant Tier 1? And second question, am I right to assume that all of your outstanding hybrid debt falls under the grandfathering regime and is not Solvency II compliant in its own right?
Okay, so it's not at all what I said. And it's not, I didn't say that we wanted to be the first one to use this Solvency II Tier 1 compliant. We will see in the future. And second, yes, you remember that we mentioned that we were benefiting from the grandfathering, and this is a given. So we will benefit it for 10 years. So we'll keep it. And you remember maybe that we decided 1 year ago we decided to prolong some of this debt in order to full benefit from it. So this is something that we will keep.
Okay. Do we have questions from on the no? Okay, so I believe that we have exhausted your the list of your questions. Thank you very much for your attention. Thank you very much for coming for this Investor Day, and I wish you a very pleasant end of the day. Thank you.